Chinese stocks have been exploding, and JD has been one of the most beneficiaries. After experiencing a drawdown of almost 80% since all-time highs, the stock is up almost 25% in 1 week and more than 50% in 2 weeks. But why have JD going up more than the other Chinese stocks? Is this asset well priced or they are still undervalued? So let's find out. The last 3 years have been very difficult for Chinese stocks and JD as well. JD is experiencing a drawdown of almost 80% and has been going only down in the last few years. And why is that happening? Because Chinese economy is having some struggles, some real estate problems. JD has been facing a lot of competition from Alibaba, as always, and from new companies like Pinduoduo. So their margins are going down, but they are prospering as a business. Their revenues are going up. They are experiencing some slowdown in their growth, but they are still growing, and now they are showing some signs of the recovery. Not because the stock is going up in the last week, but because there have been some signs of recovery in the Chinese economy, and now with PBOC showing support to equities and trying to boost consumer confidence, we might see some stocks doing very well in the future. But in the beginning of the year, we were making some videos on JD. Actually, JD was so undervalued that their market cap was almost equal to their cash and short terms. So what that means, that you basically could buy JD shares at the price equal of the amount of cash they have in hands. Basically, you were buying this business for free. But is JD so a business so bad that deserves this? Might not. That was our bullish thesis half a year ago or 6 7 months ago. You could see our videos with our opinion and analysis on JD at that time. So JD, right now it is worth a market cap of $55. It's trading at the forward P less than 10, which is still lower. They have been growing in the last 5 years around 70%. So basically, their cash in hand is around 28 billion. Right now, almost of their market cap, or half of their market cap, is cash. They have a long-term debt of 8 billion. So if you subtract the debt to the cash, they still have net positive cash, around 20 billions, which is more than 1/3 of their market cap, which is a balance sheet pretty solid. Their returns on equity and returns on invest has been going up, which is very good. Right now is around 10%, which is not bad for a company with low margins. So and they've been paying a dividend. Right now it's around 2%, but it was 3% some months ago. Performance wise, year to date the stock is up 41%, beating the S&P 500 and the Nasdaq. Looking to our manager checklist, it's basically all check marks except margins. That is something I don't like, because this is a business model that have lower margins, but they sell goods from other brands, and they take a small margin. That's how they operate. But I prefer business with higher margin. But still, I've been very bullish on JD because they were so undervalued that I couldn't miss that opportunity, and right now it's paying off. Even though I think they have lower margins, it's not the best business in my opinion. One thing I'm being very surprised is their management team. They have been excellent in the last years. They increased their buyback program when they were trading at basically nothing, which was really good. They increased their dividend, which was around 3%, while still investing in the company. There are some good news. I like JD because they sell some things that Tmall from Alibaba can't sell. Higher higher price goods from luxury marks, for example. Right now, they have been battling with Alibaba for market share, but recently this week I've seen a news in the news that they were collaborating with Tmall. Like if you bought in Tmall, you could use JD Logistics team, and the same if you bought in JD, you could use Alipay from Alibaba. So some cooperation, which is good for business, and it's really good seeing that one of the biggest problems on JD was facing competition from Alibaba, and right now seeing the collaboration between these two companies, it is really good. So it is pro business for the future. So I'm really happy about that. So basically, JD has one of the best logistics in China, and it's one of their biggest assets, I think. So even though that's not the best business model because that's lower margin, but you have Costco, you have Walmart that works with lower margin, and they are some of the best business in the world. So I'm betting on JD, on their management, their logistics, and I'm really enthusiastic about their business. Even though they are all check marks, but margins, even though they are lower, this is a really good business as well. So very strong balance sheet, low debt, returns on equity and on investments are above 10%, which is very good for a business like JD. So moats and competitive advantage, even though I've classified that with a score of narrow moat, it could be a wide moat because they have a really great logistics team. They sell some brands that other companies or other e-commerce companies doesn't have deals with them. They've been free cash flow positive every year. They've been returning capital, which is very important for investors. They've been doing buybacks and doing a great dividend. So this is very good. So for me, let's check if it is still undervalued. That's why you are watching this video probably. So what is my assumptions, or what will assume? I will try to be conservative. Free cash flow margins were above 4%, but in the last 2 years have been around 3.6%. So I'm being conservative in my base case, using a 3.5% margins or free cash flow margins. Since this is a Chinese company, for me it's a safe Chinese company, but the risk will be medium. I will assume a discount rate of 14%, which is really high. So for me to buy JD, it has to be with a big margin of safety. Growth rates, I will assume between 6 and 4% for the 10 years. P, I will assume only a 15. Even though I think this is a great business, I don't want to assume a higher multiple because I'm trying to be conservative in my analysis. So JD, it's a company I do really like, I do really love this manager, but it's not one of the best business models out there. So with these assumptions, the fair value of this company is around $40. Right now they are trading at $40, so they are trading at my intrinsic value, I would say. Of course, if you use a discount rate low, around 9-10%, this company will be worth around $50 to $60. But for me to buy JD has to be a really low price. And at $23, like they were trading 6 months ago, it was a steal. But right now it's trading around fair value. So I will have to reassume that, analyze again, do my due diligence, and I don't know what to do with my stock. I do own, full disclosure, I do own JD stock. It's one of my core positions, and I do really like the business, but it's not one of my biggest investments or one of my favorite investments. There are plenty of food companies on China, and right now it is recovering, and they are going around, in my opinion, my intrinsic value, but it's getting closer to a fair value of most of investors. Even though this is going up a lot, they are still trading at a fair value in our opinion, so it might still be a really great investment. Bear in mind, China is still growing, GDP growing at 4%, economy might be going up even more because of this bazooka and stimulus from the PBOC. So JD might be one of the beneficiaries from this boost. So I hope you liked it. I hope you like this analysis, and if you want me to do more videos about Chinese stocks, write in the comments. See you next time.